My guest today is Jonathan Duong. Jonathan is the president of Wealth Engineers, a Denver-based fee-only financial planning and wealth management consultancy that is focused on low-cost asset management. He previously served as the director of investments for another Denver-based wealth management firm, and he also worked in Ernst & Young's Transaction Advisory Services Group, where he focused on advising corporate and high net worth clients on investment tax and planning issues. Jonathan holds the CFA and CFP designations, and I invited him to the podcast today to share insights about index fund evaluation and index fund investing. Jonathan, thanks so much for joining us today to share insights and tips all about index funds.
Yeah, absolutely. Thank you for having me. Looking forward to the discussion for sure.
Cool. I'd love to start out just by understanding a little bit more about your background. Like, how did you get into financial planning, and in particular, the type of financial planning that you do or specialize in? What makes your approach different?
Yeah, so my history kind of really goes back to, I'd say, two inspirations. So I think in general, my family kind of bloodline is very entrepreneurial. So most of my dad's side of the family, they own their own businesses, started their own businesses, always really kind of been focused on thinking through, strategically how to build, the life that they want. So there's kind of an entrepreneurial mindset, kind of if you want it, you can have it as long as you put in the time and effort type of mindset. And so that kind of really for me always meant like I'm always looking to figure out ways to, get more from less, right? Figure out how to squeeze more juice from the orange, so to speak. And I think that's kind of what set me on the path largely towards business and towards finance in general. And then, really had the opportunity, very grateful for, undergraduate coursework that I took, particularly under a couple of professors at my alma mater, Cal Poly. And, one in particular, I studied under a professor named Professor Larry Gorman. And in our business 431 class, if memory serves correctly, actually got exposure as an undergrad to the Fama French 3-factor model. And so some of your audience members, may know pretty famous research by Eugene Fama and Ken French, basically looking to improve upon the way that stock returns can, be analyzed or explained beyond just a market beta or a single factor model into a multi-factor model, looking at, in this case, in addition to market beta, also looking at size or the small cap, risk premium, as well as the value risk premium or the relative price premium. Long story short, just got exposure to that when I was an undergrad, and it kind of just clicked. It's like, this makes a lot of sense. And then after that, the rest is kind of history. I was just hooked, completely interested in how to invest, how to think about investing, how to manage money. And after that, it was just kind of one step after another, from the CFA to the CFP, and ultimately, a lot of story in between, but that's kind of the foundation and the framework. Yeah.
So what makes your approach different in your practice?
So I think, just briefly high level, I think the three things that we really focus on, that the reason clients ultimately come to us, I believe, one is, a more integrated approach that understands how all of the different components of, an individual's personal financial situation fit together. So I think there's a lot of lip service that gets paid to holistic wealth management or comprehensive wealth management. And it's kind of a catchphrase that I think gets thrown around a little bit too, easily without a whole lot of thought. But for our approach, that means a lot. It actually really means a lot. And so that, for us means really understanding the tax implications of the decisions that we're making in real time. So whereas a lot of times a client's not really thinking about tax issues until April, we're looking at those throughout the year and figuring out, are there things that we can do either from a capital gains perspective or a Roth conversion perspective, or thinking about Medicare premiums, how all these things fit together from a tax perspective. Can we optimize or strategically plan during the year so that come April, the client situation is a lot better? Because as we all know, most tax related things, you can't wait until April. There's a few, you can still make an IRA contribution or a Roth contribution. Most other things have to be done between January 1 and December 31st. So it's really that integrated tax mindset and thinking through holistically how all of these things fit together from a tax perspective, looking at risk and insurance, thinking about estate planning, in addition to all the other things that you would think about with with traditional financial planning. So I'd say that's one. Second, about a quarter of our clients are business owners or are very directly connected in terms of a partnership or equity stake with their business. And coming from a background where I've got a lot of corporate finance experience and sort of really understanding valuation, how businesses are valued, how they grow, how they transact, a lot of those types of things tends to be an area of differentiation where we can have really deep, really meaningful conversations with business owners to help them prepare for something like a liquidity event and selling their business as they approach retirement. So I think that's another big factor. And then of course, it all kind of comes back to a focus on cost efficiency, tax efficiency, transparency, putting a client first, and you put all three of those things together, and that's really how the business has grown, and I think why most of our clients come to us.
Okay, cool. That's really helpful to keep in mind. Let's talk a little bit about index fund selection. Though most people in my audience, I think, will know at a high level what an index fund is, i.e. that it represents like a basket or a collection of individual securities that you can buy as a single investment to get exposure to all the securities in the basket at once, whether you're doing that for diversification purposes or low cost or to bet on a certain investment thesis, whatever the case may be.
Yep.
But they tend to come in a couple different flavors. There's mutual funds, there's ETFs. What are the key differences first, to start between these two types, things like timing of trades, volatility, tax efficiency, fees? Does one tend to be better than the other for retail investors in your view?
Yeah, so I guess let me just start by saying, the obvious from a compliance perspective, being that I am, my firm is a registered investment advisor, and I am, of course, an investment advisor representative of that firm. Obviously, none of what we're talking about here is in specific investment advice. You should certainly, complete your own diligence, consider your own financial situation, consult a financial, tax, or a legal professional, so on and so forth. So with that said, yeah, I mean, most of the time we're thinking about an index-oriented investment. I think historically people think index fund, they think of the mutual fund or the open-end mutual fund structure. That's kind of where all of this started. But as we all know, the advent of the ETF structure has really taken off. And so you have this huge influx of choices that are now available, many of them coming out, I'd say most of them coming out in ETF form. So as far as the differences there go, I mean, there's some obvious, most of your listeners probably know is, intraday trading, where an ETF you can trade, at any point in time during the day, whereas a mutual fund is always going to trade, one time per day at the end of the day, closing value. So what that really means is if you are an active trader, if you're somebody who is, trying to implement a tactical strategy, obviously an ETF structure can be more favorable. If you're a long-term investor, I'll be honest, most of the things that we're going to unpack here in a second don't really matter that much as long as it's a well-designed open-end mutual fund. So there are other differences there that, obviously we need to be mindful of. So costs is a pretty large umbrella here. And there's a lot of things underneath that. Certainly in general, the ETF structure tends to be more cost efficient in that it's typically cheaper, not always, but in many cases, you're going to save a basis point or a few basis points on the expense ratio with an ETF structure. That's certainly one consideration. Second consideration is all else equal. ETFs are usually more tax efficient, but I don't think that's always the case. I think that's sort of an oversell in some cases. A lot of times, if we look at a well-designed open-end mutual fund and compared to an ETF, let's say from Vanguard or some of the other options, say for Vanguard specifically, the ETF and the open-end mutual fund, they're exactly one and the same. It's just a different share class of exactly the same fund. And so you're going to have a lot less differences in that type of structure. In other cases, you can make the argument in favor of the ETF. Beyond that, other things I think, every investor needs to look at, bid-ask spreads, where if you have a thinly traded ETF, where let's say it's either in an asset class in an area of the market that just doesn't have as much liquidity, or if that given ETF just doesn't have a whole lot of market share, it's fairly small, you can end up with a situation where you have a substantial bid-ask spread. Basically what that means, again, your listeners probably know, the bid and the ask represents, what is the market maker or the other party you're trading with, what are they willing to buy that share of that ETF for, and what are they willing to sell it for, and the difference between that represents the spread spread. And the wider that spread is, the larger the cost for the investor. So that's certainly another consideration as well. I think, outside of that, I'll be honest, as long as you're choosing a well-designed open-end mutual fund and a well-designed, transparent ETF, the differences I think are a lot fewer than they are, they're not nearly as significant as sometimes they're made out to be.
So you've used this term a few times now, well-designed open-end mutual fund, well-designed ETF. Can you explain what makes such a fund, both on the ETF side and the mutual fund side, well-designed?
Yeah, so there's several things that I look at, right, in terms of evaluating. When I go through and I look at my due diligence spreadsheet, which I have up on my screen right now, and I'm kind of looking at, there's many different factors, right? So of course, I'd say the single most important thing above all else is what index or benchmark are we actually tracking here, right? You'll hear, all the time people just throw out the term index fund as though that actually means something in and of itself. Well, we can have an index fund that tracks the S&P 500, US large cap stocks. We could have another index fund that tracks, emerging market stocks or real estate or so on and so forth. So there are many different asset classes. We have to understand which benchmark, which index we are actually seeking to track. That's probably the single most important. And all else equal, in most cases, I'm looking for, first and foremost, I'm looking at the index and then going out and finding the funds that are tracking that index, not the other way around. So I'm a big believer, and I encourage all of our clients to adopt this mentality, this mindset. And I encourage everybody who's even not a client of ours just to think through this philosophy, which is strategy first, product second. If you are talking to somebody who's starting with product first, i.e. you have to be in this fund, usually that's a pretty good indicator that maybe that's not the right solution. You really have to start with strategy first. So what strategy are you trying to implement? And then you go to the marketplace and find the best funds that fulfill that solution. So certainly we need to look at the benchmark or the index. We need to look at whether it is truly an index fund or whether it's passively managed but tracking that benchmark, or whether it's in this increasing, bucket that's now available in ETF form, which is a semi-transparent or non-transparent, actively managed, type of solution, but is inside of an ETF structure. And those are three very different things that investors, I think, need to be, acutely aware of.
Can you comment a little bit more about the diffs between those? A classic index fund, a passively managed, but tracking the index, and an actively managed, like how should investors think about what are the variances between these?
Yeah, so I think the easiest way to kind of wrap your head around this is a classic index fund, say something from Vanguard or iShares or Spider or any of the other fund families. What they're doing is they're licensing a commercial index. So the index itself is not investable. It's largely a performance tracking or a benchmark tool for a certain set of securities. It's not actually directly investable, but the fund family is licensing that index and they're paying a fee to do that. And then the objective of the mutual fund manager, or if it's an index mutual fund or an ETF manager, is they want to try to track that index as closely as they possibly can, less the fees, of course, that they charge. And of course, that means that a mandate of a well-designed, true commercial index fund is to minimize what we call tracking error, the deviation from the index performance relative to the fund performance, right? So that's your typical commercial index fund, the most famous, of course, being the S&P 500 index. So if you are a fund manager, you want to license the use of the commercial index, the S&P 500, then your goal becomes to track that particular index. The second bucket, passively managed but not strictly index funds. Probably the most famous, of course, here is going to be a fund family that many of your listeners may know, which is DFA, or Dimensional Fund Advisors, right? So DFA uses a passive strategy. It's a rules-based strategy, and they have benchmarks for each fund, of course, just like any other mutual fund does, but they're not strictly trying to track the index necessarily because it's not an index fund. It's a passively managed rules-based fund. So the difference being, it's not the manager simply saying, well, I think it's time to get in or out of the market, or I think, Apple is poised to take off, but I think, Microsoft is not going to do as well. Just, of course, naming names here, not any specific prognostication, of course. They're not doing that. Rather, they're defining a certain set of rules. and they're implementing those rules in a systematic way. And that ultimately makes it passive. It's not strictly an index, but it's passive. It's not active in the sense of what we would call a tactical type fund. And then, of course, the third bucket, like we talked about, that historically has been the actively managed mutual fund, and now is coming in other flavors and forms like semi-transparent or non-transparent ETFs, where the manager is actually trying to outperform through security selection or market timing or other things like that. And so because of that, you're not just simply accepting the passive structure or the index, you're actually trying to outperform the benchmark. And that's there are an increasing number of funds that fit within this bucket, but that are not the classic actively managed open-end mutual fund that are now in the ETF structure.
Cool, that's really helpful insight. You mentioned that the really right way to do this is strategy first, product second. So look at first analyze what is the index. And I was curious, how can people search for what the available index options are so that they don't go straight to fund, but they first think more broadly about what index suits their investment philosophy and risk profile? Like how can they even, I guess, go and search and find what the list of indexes options even are?
Yeah, so I mean, certainly I'll throw in, my recommendation that it all starts with financial planning, right? Even before we get to a point of designing a portfolio, I think it all starts with an investor's financial plan. You really have to think about what asset allocation do you actually need in order to fulfill your goals? Because there's no single right answer, and just your age, as an example, is not a sufficient, indicator of that. Once that's been established, then I think you can start this a couple of different ways. Right? So the most typical, I'd say, would be use a site like Morningstar or ETF.com or ETF database or one of the other platforms that are available that allow you to do side-by-side comparison of various funds, right? I think that's certainly one approach. And all else equal, if you kind of already know you're going to stay within the Vanguard, iShares, Spider world, that's probably the easiest thing to do, is just to be able to simply go up to one of these websites and make some comparisons with the underlying characteristics of those ETFs or funds. For those who are more nuanced, more want to understand the nitty gritty, then that's where you could go directly to one of the commercial index licensors websites. So you could go to MSCI. You could go to CRISP. CRISP, CRSP, is the Center for Research and Securities Prices. That's what Vanguard increasingly uses for many of their funds. Of course, another being Standard & Poor's or Dow Jones. You could go to these particular websites, and they will publish the specifics of how they define that index, what that index consists of, how many companies are in the index, which countries, if it's a stock-based index, is it a growth index, how do they define that? They'll publish all of this information. If you really want to dig into that, you can, and then work backwards from there and say, okay, well, now that I know which index I want to focus on, say the Russell 3000 or the S&P 500 or the ACWI or something like that, and then say, well, now which fund families license that particular index, and then you can go and make that selection. So really two ways to do it, is kind of a top down or bottom up, I guess you could say. Okay,
cool. That makes sense. I was also curious, you mentioned in the first bucket, the classic index fund where it is just strictly tracking the index. If the point of those funds is to minimize tracking error, so they're not trying to be active in any way, they don't have any particular investment thesis, they're literally just tracking. I'm just curious, why can't computers just do this and make the fees almost zero? Why do you need humans involved at all?
Well, so I think there's a few things. I mean, realistically, if we're being honest, I mean, the reality, we're as close to zero to the point where, shaving 2 or 3 basis points is basically meaningless at the end of the day for all intents and purposes. So we're basically darn close to there, even if we're not technically there as far as zero cost. But we've really reached to a point now, right, where trading ETFs is, for all intents and purposes, free, right? from a transaction cost perspective. You still have to be mindful of the bid-ask spread and deviations from NAV and a lot of other things. But from a transactional cost, that's zero. The expense ratio for if you're really your highest priority is cost, you can build a portfolio for 3 basis points or 4 basis points at this point. That said, in terms of where I think we are going, I do think that's a very viable possibility, right? The fact that it's technically the S&P 500 index isn't really that meaningful or important for most investors if their goal is just simply to invest in US large cap companies. So I think increasingly, this is the democratization of investing for, for the world, and certainly for US investors, where we've never had more choices at lower cost and easier access than ever before. And I think that's going to continue. I think there's an increasing number of solutions now that are going to be focused on basically abandoning the index and allowing for direct indexing, is what's largely called, where even with a smaller portfolio, you may be able to, or a smaller amount of capital, recreate any index you want without necessarily having to utilize the index license or the index fund. So I think there's a lot of research happening there, a lot of tools coming about, and I think that's good. I just don't see it as being nearly as transformational as the difference from, let's say, an actively managed mutual fund charging 1.5% to a total stock market index charging 5 basis points. That's a heck of a lot more meaningful for the average investor. So.
Yeah, that's true. That's a fair point.
Yeah.
Okay, cool. So that's a little bit of that's really good background on the different indexes. How you can research some. Let's say you've sort of zeroed in on the index you want to add to your portfolio. Could you walk us through sort of step by step your approach or best practices for how to actually evaluate particular funds? Like, say there's a fund you haven't come across before, you're trying to decide how good the fund is as an investment. Step by step, like, what are the attributes, the criteria, the performance indicators that you personally analyze to evaluate a fund?
Yeah, so I think, again, I'm going to hark back to my financial planning mindset, because I think it's always so important, is to always ask yourself, why am I looking to add this fund, or why am I looking to replace a fund in the portfolio? Is it simply because I'm looking for the latest flavor of the day, or is it because the asset allocation that I've defined in my plan needs me to fill this particular slice of the portfolio, and so therefore I need to go ahead and review that? So that's kind of the most important thing. Once I've established that and I say I've got this asset class slice or this sub-asset class slice that I need to fill, then the things that I go through and look for, certainly like we talked about, the benchmark or the index, critically important. I'm also looking at the actual underlying holdings within that fund. And if it's a commercial index, obviously I'm expecting darn close to full replication. If it's a passive oriented investment but not a strict index, then I'm still going to go through and look at the underlying portfolio, and also to verify that the index is consistent with what I'm looking for. So say, for sake of argument, if you go look at US small cap stocks or US large value, well, some indices may have a couple hundred stocks, some may have 1,000 stocks. So it's really important to understand how many positions are actually within this portfolio, and is that a sufficient level of diversification for what I'm seeking, right? So that's kind of another thing I consider. Next, of course, is fees and expenses. What is the underlying expense ratio of the fund? In addition, are there other things that I need to be mindful of beyond just the expense ratio that could impact my net returns? So bid-ask spreads are certainly one of them, like we talked about. Another, which we're not going to go deep down the rabbit hole necessarily, but is this idea of securities lending revenue. Which is a strategy that certain funds and certain fund families utilize, where they are going to generate some additional revenue for the fund by lending out underlying securities, and that can be used to offset the actual fees and expenses in the fund. Now, certain fund families give 100% of the revenue generated back to the investor. Other fund families only give a portion, and others keep it all for themselves as profit for the fund. So I'm looking at all of the embedded costs. And then next, I'm looking at taxes. I'm trying to understand what type of tax activity can I expect, or should I expect, in this particular fund, and where does that make it appropriate to fit within my portfolio? Is it appropriate within my IRA or Roth IRA? Is it appropriate with my brokerage account or my taxable account? And then, what can or should I expect in terms of breakdown between qualified dividends, non-qualified dividends, any embedded capital gains, other things like that. So I have to be really, really mindful of those things. And that's really just on the equity side. On the fixed income side, there's a whole, other series of things that we need to analyze. And it's where I actually think in a lot of cases, the comparison and nuances between fixed income can be even more in depth than it can be on the equity side, even though, I think most investors tend to focus on stocks because they're more exciting.
Got it. If there is a kind of a pithy or short version of it, what are some of the indicators or metrics that you look at on the fixed income side?
So, I mean, the big things, if we're looking at what we can control, right, as investors, we largely can control, two things above all else. So that's term, how long dated are the bonds we're investing in? So how much risk we are taking by investing in shorter term, intermediate term, or long-term bonds, what we call term risk, and the sensitivity, largely what we would call duration, the sensitivity to changes in interest rates, which is a similar evaluation. So we look at that, and then we look as well at credit risk. Am I investing in treasuries? Am I investing in corporate bonds, municipal bonds, so on and so forth? So those are really the two parameters that we look at. And within that, there's a whole lot, of course, to unpack. So we're looking at, for example, on the yield side, what is the yield to maturity of the underlying funds? And obviously, no surprise, with interest rates, being close to zero on, high quality debt, yields are, at historic lows. And so investors are kind of faced with some challenges. Are they willing or do they need to take more term risk? So going from really short term to intermediate term or longer term bonds, or do they need to take credit risk in order to get some yield? And that's a real challenge that we all face. So there's a whole lot of detail to kind of analyze and make comparisons there, but it largely can be thought about in those two buckets: is term risk and credit risk. And then, of course, there's a lot of other considerations, whether it's taxes related to tax exempt interest in municipal bonds, inflation protected bonds like TIPS, or other things, like that. Certainly more detail there. But that's what I think most investors these days are really faced with, is ultra low interest rates, and what does that mean for my portfolio and my long-term plan?
Yeah, I guess right now, is your view that given that rates are nearly zero, is this a pretty risky time to be investing in fixed income, funds, let alone securities?
I guess it depends on how you define risk, right? If we define risk as, the potential loss of principal, I don't know that it's really that different today than it was a year, 2, 3 years ago, depending on, of course, which segment of the market you're in. But if we define risk as the long-term risk of not reaching our financial goals or running out of money, then yeah, I do think it's very significant for investors, right? Where certainly inflation is really low, right? So that's a benefit that most investors have. We're not facing rampant inflation at the same time we have incredibly low yields on debt or on fixed income. But I do think it's going to be a challenge to a lot of investors. To our clients, we're really encouraging everyone to think through the trade-offs. And the two most obvious are: do I take more risk on the bond side but keep my broad asset allocation? So if I was a 60% stock, 40% bond investor, one option is I take my fixed income and I take more risk. So I'm adding more credit risk, or I'm adding, more term risk. That's one option to get a little bit of increased yield. The other is to say, well, I want to keep my fixed income, quality and duration where it is, but I'm going to add 5 or 10% to my stock allocation. So instead of being 60% stocks, I'm going to be 65% stocks or 70% stocks. Now, there's no perfect answer here. It's definitely a series of trade-offs, but I do think investors are really going to have to give a lot of thought to their plan, whether they're accumulating or whether they are decumulating and withdrawing. They're going to have to give a lot of thought to can they tolerate the volatility of stocks? And if so, my personal view, all else equal, is that the scariest thing in the near term, which is stock volatility, is likely going to be the thing that saves us over the long term, because simply putting a large percentage of our assets in an asset class like bonds that yields 0.25% or 0.5% is just not going to get it done. So
yeah, that's good. That's a good point. Hey, I want to backtrack to something you said earlier, which is that you were talking about some of the attributes you evaluate to determine the worthiness of a fund. You mentioned things like the index itself, the holdings, the expense ratio. You also talked a little bit about taxes. and maybe the tax efficiency.
Yep.
How can investors, like, where do investors look to analyze, the tax profile of a fund?
Yeah, so I think there's really two things. So in terms of like direct feedback, you can go up to Morningstar or look at some of the other research websites, and they will give you a tax efficiency score, or they'll kind of show you are there any embedded capital gains you might be exposed to. You can see distributions, those types of things. So I think that's one way. In a more detailed, kind of nuanced way, I can get a pretty good handle and flavor by looking at and reviewing the actual index, and then knowing what type of index or asset class we're focused on. So for example, if it's not that I'm an advocate necessarily of a high dividend yield strategy, but I do know a lot of investors are. And so you have to be mindful of, if you're a dividend focused investor, increasingly we have the reality that dividend yield on many stock index portfolios is higher than the yield on the fixed income we own. So we might be seeing a 3.5% dividend yield on our stock index fund. Meanwhile, our fixed income has a yield of 0.5% or 1%. Now, the impact of that's going to be highly disparate in each individual tax situation, but we really have to look and understand that. So my long-winded way of saying is, I can get a pretty good sense based on the asset class we're focused on and the index we're focused on, can I expect that this is going to be a tax efficient fund with minimal unexpected capital gains, ideally qualified dividends, and so on and so forth, or should I be expecting a lot of activity that could be pretty detrimental to the client? That's certainly one of the reasons why, from an investment perspective, if we're looking at a high tax bracket and client, where let's say they're in the 35 or 37% tax bracket, they're also facing state taxes, we are very, very acutely focused on tax efficiency. And that's where, say for sake of argument, if we're looking on the equity side, certainly a total stock market index fund is likely to be more efficient than a more narrow focused index fund that only is holding a small basket of stocks. And also where, if we are trying to tilt to size or value, where DFA or dimensional fund advisors adds a lot of value because they've got total market funds, but that also weight to size and value within that total market fund. And this year, by all estimates, we're not expecting to see any capital gains at all, even amidst the volatility and the growth we've seen since March. So certainly, that's a big focus, and particularly true if a client's in California or New York or another high state income tax state.
Got it. Hey, you mentioned this. You mentioned embedded capital gains earlier. Can you explain what that is?
Yeah. So, I think one of the differences that investors do need to be mindful of when they're looking at an ETF versus an open-end mutual fund is the ETF structure, the way that it's designed and the share redemption process and so on, tends to make it more tax efficient, and tends to result in the case that it's not going to distribute in many cases any capital gains going forward, right? So in other words, if you buy the fund and you don't sell the fund, you should not expect anything beyond the dividends when you get your 1099 from your brokerage firm. And that's just a design feature of an ETF, and that's why they're typically talked about as being tax efficient, even though there are many good open-end mutual funds that are also equally tax efficient. Okay, but on the open-end mutual fund side, because of the way that the fund family has to redeem cash, or the fund manager has to redeem cash when some investors want to sell and get out, other investors want to buy in, what can end up happening is the mutual fund itself can incur capital gains, and then it has to go in and distribute those out to the fund holders. So what can happen is you could invest in a fund and you don't sell, you never sell, and yet you're getting a 1099 that has a capital gains distribution from the fund, simply because the mutual fund has to distribute that capital gain under the tax law.
Oh, I see. So the fund manager, as they're just managing the normal inflows and outflows of cash into the fund, there may be, if I'm understanding correctly, there may be times where they would actually have to liquidate assets in the fund, would incur capital gains at that point to the fund. So that's the embedded part, and then they distribute those out in your 1099.
Yeah,
Right?
or other examples, like we're going to see likely some changes to the S&P 500 composition, where, and I don't really track super closely the day-to-day composition of the S&P 500, but we're going to see some entrants. Tesla may come in, other previous companies, within the S&P 500 may leave. That can cause a capital gain in and of itself, and that's one of the downsides. Now, is it the end of the world? No, but it's one of the downsides of a commercial index tracking ETF or mutual fund, is that the mutual fund manager, the ETF manager, has no choice but to, take these actions, which can result in tax consequences. And that's just simply because they have to follow the index. They don't have any latitude the way a passively managed fund would.
Why are ETFs not exposed to that? Because they also have to strictly follow the index as well. But if
so they have an ability to synthesize the redemption process, where they can actually go and sell out of a given portion of the fund and buy the underlying securities, and through that they have the ability to manage that so that the actual net effect to the investor is not to actually ever have that capital gain be forced to fall through. So it's just a difference in the share redemption process, and it gives the ETF an inherent advantage, not always in reality, compared to a good and well-designed mutual fund, but it does give it that inherent advantage because of the redemption process that a mutual fund, doesn't have. So
interesting. Okay, cool. Talking a bit about expense ratios, what are the mechanics? How do expense ratios actually get deducted when you have money invested in an index fund? Is it literally just like they just take a % of the AUM? Monthly, quarterly, annually, as the case may be? Or is there more?
Yeah, so most funds, it's going to be a daily deduction. So when you look at performance, you're always going to see performance net of fees, and that includes obviously all of the cost structure within the fund. So we have to understand, of course, that the fund certainly has an operating cost, right? An expense to operate the fund, and of course there are other costs that are embedded within the performance of the fund as well. So the expense ratio typically going to be deducted on a pro rata basis, so 1/365th per day, and so you're always going to see net of fees performance. But in addition, when a fund, let's say, has within it, it's facing its own bid-ask spreads. So not as big of a deal for, let's say, US large cap stocks, where they're super liquid. There's a huge market and the number of trades taking place every day in all of the names that are really hot right now, whether it's Amazon or Apple or Microsoft or Google or otherwise. There's incredible liquidity. It's never an issue. If you look at some of the more opaque areas of the market, say micro cap stocks or small cap value stocks or otherwise, there actually can be bid-ask spreads legitimately that can detract from the returns of the fund. And so you're always going to get the net returns not only after paying expenses, but also after paying bid-ask spreads. And then on the upside, we talked earlier about securities lending revenue, where if the fund is generating securities lending revenue and giving that to the investors, then that can actually be a positive lift. And there have been examples in the past of really well-run funds that generate enough securities lending revenue to actually fully cover the expense ratio, where the actual true cost of ownership in the fund is zero, or in some cases negative. Now, that's not going to be very common at all or probably won't happen at all in super large, mega cap type funds, just because there's no real, huge market for securities lending revenue there, but there can be in more opaque areas of the market. And so, investors just always have to remember, when they're seeing performance after all of the costs that are, taking place within the fund itself.
Got it. Okay, cool. What do you recommend are the best ways to search for index fund options to invest in? And in particular, are there like any free tools that you recommend that are useful for searching and evaluating and filtering fund options? And what are best practices for using some of these tools?
Yeah, so I mean, if you're just starting out, I think Morningstar, ETF.com, ETFDB.com, I think are good tools. I think they can kind of help you, with a top-down approach, for example. I also I like ETF Replay. I think is also a good tool to kind of do testing and kind of screen for ETFs. I think is another good one. Once you've got a bit more experience, Personally, I find that the absolute best place to go is the actual fund company's website. Right. So I'm not going to say it's always the case, but I think sometimes when data gets basically sent from the fund company into, some of these big, huge, resources or research tools, sometimes it gets a little lost in translation. So I always want to go directly to the source. And so I'll typically end up going directly to Vanguard, directly to iShares, to Dimensional, to Spider, you name it. And some of the, other upstart, fund families as well. I'll go directly there. And that's where I'm going to go find all the information that I'm looking for. But if you're starting with a top-down approach, I think some of those resources can be pretty good and allow you to do a side-by-side comparison to kind of get an idea, particularly when you're searching across fund families. So if you're comparing an iShares fund to a Vanguard fund, obviously, unless you're going to go build the type of diligent spreadsheet that I would, you're going to ultimately, find it a lot easier to use a comparison tool like that.
Got it. Makes sense. You mentioned one tool, ETF Replay. Is that a tool where you run simulations?
Yeah, so you can do back tests, you can do simulations. I mean, I obviously, my view and philosophy is, you can back test your way to anything, right? So that's not really how we should approach this, but rather it's helpful to kind of better understand. For example, if we look at the most recent, the COVID decline in February and March, I think it's really instructional for investors to understand how did, for example, the bonds that I own, how did they actually respond in that type of a crisis, right? And there are many things to consider there, namely, when we look at the different asset classes, we certainly saw, right? If you had, credit risk in your bond portfolio, if you had bonds that were not quite as liquid, for example, if you basically owned anything other than treasuries and cash, you did see a volatility and decline. And so a tool like ETF Replay or some of the other tools can help you to kind of understand how did this asset class actually perform? Not that that's a prediction for the repeat or to repeat into the future, but rather to better understand the risks that you're taking, in certain parts of your portfolio.
Okay, awesome. Closing the tail end of the discussion, I wanted to get your thoughts on some specific names and ticker symbols of funds that you view as solid picks for investors who want exposure to different types of asset classes. So maybe I'll just rattle down a few of the asset classes, and if there's one or two names that you tend to recommend, or I actually don't want to say recommend because that's not what you're really doing, but more that you think are potentially good picks to do some additional diligence for somebody who wants exposure to that asset class. I would love to kind of get your thoughts. So US total stock market to kick off.
Yeah, so I'll certainly start by saying, I don't work for Vanguard, I don't work for Dimensional or CFA, but they tend to be the fund families that after all the research, all the diligence that I'm doing, I feel like not only they meet all the criteria that we've already talked about here, but they also tend to be very investor friendly, putting investors first and being very transparent as they do that. So that tends to be, in most cases, I don't need to leave those fund families. Not always, but in most cases. Thankfully, there's an increasing number of options for sure from iShares, from Spider, from some upstarts like Avantis Investors is an example of some folks who have left DFA or Dimensional and are kind of making some inroads, through this new organization underneath American Century called Avantis. So that's kind of another, to get back to your point in terms of US total stock market, certainly if we look at what Vanguard has to offer, I think VTI is the classic, US total stock market and can be a really good tool. iShares has, I think it's ITOT is another, good option. And then certainly if you are working with, a financial planner, financial advisor who has access to Dimensional's core and vector funds. I personally think if you are investing and you are looking to tilt to size and value, the core funds can be a great tool for that. So that's DFQTX or DFTCX are great tools because they allow you to do that size and value tilt, but within a total market structure, so it's a lot more tax efficient. But the big thing is just so many choices now. As long as it is a widely diversified index, what's in it, and you're paying a fair fee, you really can't go wrong for all intents and purposes. There are bigger fish to fry. Let's put it that way. So.
That's a fair point. Okay, what about total international stock?
Yeah, so on the international side, I think it's important for investors to make the distinction to understand, are they taking that total international approach, like you're mentioning, where they're investing in not only developed market countries like Germany and France and Japan and so on, but also emerging market countries like the BRICS, so Brazil, Russia, India, and China. If they are investing in that total market structure, again, I think Vanguard's got a great solution. VXUS, I think, is a really, really good tool. I think as well, iShares IXUS is their kind of comparable option. And then alternatively, if investors are saying, hey, I want to control my exposure to developed markets and then emerging markets separately, then that's where you might use something like a fund that tracks the MSCI EFI index, and then separately another emerging markets fund. It might be any number of different indices that do that. That's where you might use something like VEA and VWO from Vanguard, or you might use something, I think iShares has, I believe it's IDEV is their developed markets ETF. And then I think they have, I want to say it's IEMG, although I may have the ticker symbol wrong. That's their emerging markets fund solution. So just depends on whether you're taking that total market structure or you're actually looking at developed markets as one bucket, emerging markets as another. And of course, you can go even deeper than that. If you want to focus on Europe and then, Asia Pacific, you can really go as deep as you want.
Yeah, that makes sense. If you were to break them apart, like it makes sense. Like if you wanted to have a bespoke composition in your portfolio between developed, emerging, or Europe or BRICS or whatever the case may be, it would make sense to try to manage those separately. But if you really wanted just a total stock market ex-US, is there any reason why? Is there any advantage, I guess, to holding separate funds as opposed to a singular fund that encapsulates all of it?
Personally, I mean, if you're not looking to control the weight on developed market versus emerging market, I wouldn't, recommend holding them separately. You're going to end up with more tax efficiency if they're together. However, that said, one of the challenges, of course, you run into is if you are trying to implement a strategy beyond just a market cap weighted approach, then that's where sometimes holding them separately can be more advantageous or more feasible, just because otherwise you end up having to own a whole bunch of funds in order to kind of replicate that. So if you're strictly looking total market, I think that total international is a great approach. If you're getting beyond that and you're moving into a more detailed allocation, then there can be some very good reasons to separate them. It just depends on the specific investor portfolio.
Makes sense. Okay, what about dividend-focused stock?
So I think what's important here for your listeners to kind of think about is, are they focused on dividend yield in and of itself, or are they using dividend yield as a proxy for value investing? Right? And an imperfect proxy at that, right? So, if you're looking specifically for dividend yield, then you obviously want to, go and look at a dividend paying or, a high dividend yield type of index. That's going to be the approach that you're going to want to take. Alternatively, if you're really looking at value investing, then that's where, as far as what, Vanguard or iShares or others offer, there are a whole host of different choices there. And that's actually where I think on the equity side, investors who are considering deviating from a market cap weighted approach, they really have to understand what they're investing in and be very mindful of how they're approaching that, because that's really where the difference between one index to another can be critically important. Whereas it's not quite as important if you're, say, looking at a total stock market index fund, as long as you kind of own, the Russell 3000 or, another example that owns 2,500 to 3,000 stocks, it's going to be pretty similar. So on the dividend paying side, I'll be honest, it's not an area that I focus on a lot. It'd be a whole nother podcast to talk about, dividend yield as a strategy. But on the value side, I think what's important to understand here is they're not all created equal. So, the options that are available, Vanguard has, say, VTV for large cap value, VBR for small cap value, iShares, IJS for small cap value. This is really where, again, you could spend a whole podcast on the differences between these, types of ETFs and the indices that are associated with them. It does start to matter a whole lot more. But back to your question specifically on dividend-focused stocks, not an area that I spend a lot of time researching, and the rationale and reasoning there is probably subject for a whole nother discussion. So.
All right, no worries. What about U.S. investment grade bond?
So I think here again, some really simple, straightforward choices where, if you want to own basically the total bond market for all intents and purposes. Now there are exceptions to that, but what's commonly referred to as the total bond market index, or looking at the U.S. aggregate, the Barclays Ag or something like that. You could invest in BND, as a Vanguard option. If you want to go shorter term, BSV, or intermediate term, BIV is kind of another example. There are so many, options. So I think if you're looking at an investment grade or core type fund, you just really have to understand what are you actually investing in, because a lot of funds will be labeled as quote unquote investment grade. And I don't think that's a sufficient descriptor to understand what you're actually investing in. So if it is truly tracking the Barclays Ag or something similar to that, then you're pretty confident what's in there. If it's a different index, you darn well better know what's actually what you're actually investing in before you go and deploy capital.
Yeah, that's fair. I guess it's is it fair to say that the larger brokerages that construct their own versions of these funds are just more likely to have the fund composition be closer to what you would sort of expect when you hear something like investment grade bonds? I think that's what I'm hearing. Is that correct?
Yeah, I think that's probably reasonable to say. I mean, certainly if it's a true commercial index ETF or mutual fund, then the very name of the fund oftentimes is going to include the details, that you care about. For example, it might specifically, reference it. If not, you can pretty quickly go and find out, is it tracking the Barclays Ag, or is it a credit index, or is it a treasury index or something like that? And I think, yeah, all else equal, if you are looking, for example, at Vanguard and total bond market index, or you're looking at let's say Spider has their aggregate bond ETF, you can basically go and quickly look and say, yeah, it's tracking the Bloomberg Barclays US Ag, and you can be pretty confident what you're investing in there. But because there are so many sub asset classes in bonds, you really do have to complete the requisite diligence. Goes without saying, but
makes sense. What about U.S. government and muni bond or muni bonds?
Yeah, so here it's going to really depend on term. So if you just want, say, short-term treasury, Vanguard, VGSH, basically tracks the 1 to 3 year U.S. Treasury index. Really easy solution. You want to go a little bit longer term and go with intermediate term treasuries. VGIT is a great solution there. Spider, SPTI is an example. iShares, Spider, Vanguard all have solutions really in this space. Specifically on the treasury side. On the municipal side, there are some options, but they're not nearly as many as there are on the corporate or credit side and on the treasury side. So probably one of the most famous municipal ETFs is MUB, is one of the more famous ones. Vanguard released VTEB, which is their true tax-exempt bond index fund. Historically, their municipal bond funds they're technically actively managed. It's not anything that causes me any heartburn because they're low cost, they're very clear, very transparent, which is what matters most. But historically, Vanguard hasn't actually offered a municipal index fund. That changed a little while back, and so they offer VTEB as an example. There actually are others, that you tend to have to do a little bit more digging, because historically most of the municipal bond funds have been mutual funds, not actually ETFs. You do have to do a bit more digging on the tax exempt side.
I see. Interesting. Are there any names that are major names from big brokerages that you suggest on the international investment grade bond front?
Yeah, so I think probably the most common one that a lot of investors are going to look at is the BNDX. So if we look at Vanguard's BND is a very obviously well-known huge U.S. fund. BNDX is kind of its international complement. That's certainly one. I think in addition to that, Dimensional's got a lot of options here, and so we do look at and historically have used DFGBX, which is a global index fund. We've also on our diligence list is DWFIX, which is an ex-US fund as well. I think what's important here, I would say, and this is again a longer conversation, is I think investors have to understand what are they using bonds for. If they are using bonds primarily as a tool to mitigate volatility, to reduce volatility and the potential for decline in their portfolio, then they need to be careful as they leave the traditional asset classes. So if they're leaving, investment grade US debt, government credit, tips, municipals, those types of things. And it is important to understand what you're investing in there as well. But if you're leaving those things and you're moving into international debt or emerging market debt, you really, really, really need to understand what you're investing in, because the last thing that you want to do is think that you're invested in bonds and you've got stability there, and then find out that you're seeing 10, 20, 30% declines on the bond side of your portfolio while your stocks are down 30, 40, 50%. That's just not a good recipe. And most investors, they don't want that surprise to show up when the whole rest of the world seems like it's ending. So
yeah, in the U.S. there are investment grade standards, they're ratings, right, for debt in the U.S. and internationally. When I think about investment grade sorry, it's my computer. When I think about investment grade bond index funds, do they sort of utilize a common standardized rating type of rubric, or does the word investment grade is kind of in the eye of the beholder when you cross the border outside of the U.S. and go to international markets?
Well, so I think it's certainly going to depend, right? So there's plenty of non-rated debt if we're actually looking at what's actually in the portfolio. There's plenty of non-rated debt even in the U.S. So most people think about the rating agencies, right? So S&P, Moody's, Fitch, and so on, and they look at those ratings. We've seen plenty of cases in the past where those ratings don't tell the whole story, right? But even in the U.S., there's plenty of non-rated debt, right? Where say on the municipal side is a good example, where there are plenty of municipalities that, because they bear the cost of having that debt rated, they'll just waive on that and say, hey, we're not going to go ahead and pay to get it rated. Instead, we're just simply going to bring it out to market. And what's going to end up happening is there's going to typically be a higher yield or a higher expected return because of the uncertainty. But if you've got a good fund manager that really understands what is there, what they're investing in, it's widely diversified and so on, that isn't necessarily a bad thing. So on the international side, if we're leaving the traditional kind of US core debt market, then as we're leaving that, I think we have to be very, very mindful of investing in an index and benchmark that we actually understand. And of course, thankfully, there are some really good benchmarks or indices there that we can be fairly confident that we know what it is that we're investing in. So I think that's really important. And then I think peeling back the onion further is important. But I don't think on the surface, non-rated debt is immediately like, hey, this is awful. Because that can apply even in the States. So I think it is important to really understand what it is that you're investing in, not just relying on the rating in and of itself. Although, again, that can be a good proxy to better understand. I think it's more important to understand, how much is in government debt, how much is in corporate debt, how much is securitized or mortgage-backed securities or otherwise. That's, I think, what's going to really help an investor better understand what they're actually investing in. So.
Good advice. Any suggestions for real estate?
Yeah, so a lot of good choices, here, or an increasing number of good choices here, as far as U.S. REITs and international REITs. Again, I'm going to kind of go to the well because I have always been an advocate of Vanguard. And so certainly, the ones that are my personal favorites, as far as looking at the diligence list, looking at all the other things we talked about, VNQ and VNQI on the U.S. international side, and then from Dimensional, DFREX and DFITX, those four represent a really good mix, but same story, right? If you are looking at the underlying index and you're looking at understanding, am I invested in the Dow Jones, US Select, or the MSCI, US REIT? If I understand what it is that I'm looking to invest in, and if I can get that through iShares or Spider as reasonable cost, then at the end of the day, it doesn't matter nearly as much. And that's where you have to look at more of the details. So same story of understanding what I'm investing in first, and then going to the market and saying, okay, well, who offers what it is that I'm looking for? And, increasing number of options, thankfully, and, so many fund families we get to choose from. So.
Got it. And I got one more for you, last one. U.S. total market across all asset classes, or alternatively an all-weather portfolio, if the investor just wants to buy one name and get exposure to everything.
Yeah, so I think, the way I always frame this for, particularly for clients who kind of do manage investments themselves or are looking for a solution in their 401k, if they got a limited investment money or whatever, is you have to decide, because the two flavors for a multi-asset class portfolio in most cases, particularly in the index world, is, are you going to select a fixed asset allocation strategy, or is it going to be a glide path like a target date fund? Right. So most of your listeners probably know target date funds, most of them, if you're young, right out of school, and so you've got, a long time horizon in front of you, say 40 years or something like that, then the asset allocation is going to be probably 90% stocks as an example. And it will allocate across US, international emerging markets, and then a small percentage in debt and cash. And then over time, that portfolio will get more conservative as that investor gets closer to their target retirement date, say 2040 or 2045 or whatever the case is. The other type of approach is a fixed asset allocation approach where that asset allocation remains exactly the same. It doesn't change. It doesn't glide. It's going to be the same, today as it is 10 years from now. So investors really have to think about that. Do they want a dynamic approach or a fixed approach? And then within that, then you can kind of, make your decisions. On the Vanguard side, obviously they've got their target retirement funds. There are so many other fund families that offer similar things, whether it's TIA, CREF, or BlackRock, or you name it, Schwab. Almost every fund family these days has a target date or a retirement type fund. And then alternatively, on the fixed asset allocation side, Vanguard has life strategy funds, which if you want to pick a 60-40 allocation or an 80-20 allocation or so on, and you want it to remain in place and not change, then that's where those are a good solution. So I think investors just have to think about, are they looking for something that is designed to approximate that transition in asset class, asset allocation over time, or are they going to manually make those changes at certain points, over time, in their progress towards retirement? And again, that all comes back to your financial plan and thinking through where you are, how you're progressing, what rate of return you need, and so on and so forth.
Jonathan, this has been super insightful, really action-packed. I really appreciate your taking the time to chat with us. Where can listeners find out more about you, your practice, your services, et cetera?
Yeah, great conversation. I could talk about, due diligence on ETFs and mutual funds all day long. I mean, this stuff is certainly interesting. And I hope that your listeners are able to kind of take something from this and add it to what it is that they're doing. As far as what we do, best place to find us is on our primary website, which is wealthengineersllc.com. You can read kind of more about our approach and process there. Certainly, investing is a part of what we do. But like we talked about at the beginning, really wealth planning and strategy is so much more than just investing. So it's tax planning and strategy, it's healthcare and employee benefits and those types of things, tax planning, estate planning, insurance. It's really all of that. And so while I kind of started my firm really focused on super detailed, nuanced investing strategy, we've really as far as our public web presence, it's a lot more focused on overall broad wealth planning. So we don't have as much of that up there. We still have quite a bit of research and other things like that that we post. So that's the best place to find us. And anybody who has questions, you're welcome to reach out or via email or schedule a call if you'd like to learn more.
Okay, awesome. Well, we'll look forward to sharing this with our audience, and we'll link to all that stuff in the show notes. Thanks so much again, and best of luck with everything.
Yeah, absolutely. Appreciate the time. Great conversation. Hope everyone, including yourself, has a happy Thanksgiving. And I certainly hope that we can kind of stay in touch and keep the conversation going.
Cool. Awesome. Cheers. Take care.